Another day, another story. Real estate finance is a crucial aspect of the real estate industry, which involves analyzing the financial aspects of property ownership and investment. The field encompasses a wide range of topics, including property valuation, mortgage lending, and real estate investment trusts, REITs. In this video, we will explore these areas in detail and provide examples of how they work in practice. Property valuation. Property valuation is the process of determining the market value of a property. It is an important aspect of real estate finance because it helps buyers and sellers make informed decisions about pricing and helps lenders determine the value of the property as collateral for a mortgage. Property valuation can be done through a variety of methods, including the sales comparison approach, the cost approach, and the income approach. The sales comparison approach is the most commonly used method and involves comparing the property being valued to similar properties in the area that have recently sold. The cost approach involves estimating the value of the property by determining the cost of building a similar property from scratch. The income approach involves estimating the value of the property based on its income-generating potential. Mortgage lending is the process of providing financing for the purchase of a property. Lenders typically require borrowers to make a down payment on the property and then provide a mortgage loan to cover the rest of the purchase price. The terms of the mortgage loan will vary depending on the lender and the borrower's financial situation, but they will typically include an interest rate, repayment schedule, and other fees. One of the most important aspects of mortgage lending is the concept of loan-to-value, LTV, ratio. The LTV ratio is the amount of the mortgage loan divided by the appraised value of the property. Lenders use this ratio to determine the level of risk associated with the loan. Generally, the lower the LTV ratio, the less risk the lender is taking on, and the more likely the borrower is to be approved for the loan. A real estate investment trust, REIT, is a company that owns, operates, or finances income-generating real estate. REITs allow individual investors to invest in real estate without the hassle of owning and managing properties themselves. REITs can invest in a variety of real estate assets, including office buildings, retail centers, and apartment complexes. There are several types of REITs, including equity REITs, mortgage REITs, and hybrid REITs. Equity REITs invest in income-generating properties, while mortgage REITs invest in mortgages and other debt secured by real estate. Hybrid REITs invest in both equity and debt. REITs are required by law to distribute at least 90% of their taxable income to shareholders in the form of dividends. This makes them an attractive investment option for income-seeking investors. REITs are generally more liquid than traditional real estate investments, as shares can be bought and sold on the stock exchange. To illustrate how real estate finance works in practice, let's consider an example. Suppose you are interested in purchasing a rental property. You have found a property that you like, and you have determined that the market value is $500,000. You plan to make a down payment of $100,000 and finance the rest with a mortgage loan. You apply for a mortgage loan from a lender, and they approve you for a loan of $400,000. This means that the LTV ratio for the loan is 80%. The lender charges an interest rate of 4% and requires you to make monthly payments over a 30-year period. After purchasing the property, you decide to form a REIT, real estate investment trust, to generate passive income from rental properties. As a REIT, you plan to acquire additional properties using the mortgage loan you obtained from the lender. However, it's important to keep in mind that taking on additional debt through mortgages can increase your financial risk. If the properties you acquire do not generate enough income to cover the mortgage payments, you may end up defaulting on the loans and losing your properties. To mitigate this risk, it's important to thoroughly research and analyze potential rental properties to ensure they have strong cash flow potential. Additionally, it may be wise to maintain a reserve fund to cover any unexpected expenses or periods of vacancy. Overall, investing in real estate through a REIT can be a lucrative way to generate passive income, but it's important to approach it with caution and diligence to minimize risk. Thanks for watching.